Most people believe money is just a piece of paper, but what they don't know is that this piece of paper can do a magic trick. The magic trick this piece of paper can do is that it can clone itself if you put it in a cloning machine. The only drawback is that the cloning process takes a long time, around 9 years. As you can imagine, if you collect and find enough dollar bills early in life and have the patience to wait for the cloning process to finish, you'll have plenty of dollar bills to live comfortably for the rest of your life. And that is what people call FI, which is short for financial independence or financial freedom. Sadly, many people don't start the cloning process or don't even have the patience to wait for the process to finish, and therefore their money will never perform the magic cloning trick. The other cool thing about this cloning magic trick is that you can retire from your job entirely if you have enough dollar bills in the cloning process. As you can imagine, only having $10 in the cloning process won't do the trick for you to retire, since you only have $20 after 9 years of cloning. But imagine having $500,000 into a cloning mechanism and wait for 3 cloning cycles to finish. Your $500,000 will become $1.5 million. In 1995, a smart man, William Bengen, discovered another cool trick. He learned that the moment 4% of the money you have in the cloning process is the same number of dollars your life costs for an entire year, you can never run out of money if you decide to retire at that moment. I'll rephrase. William discovered that if 4% of the money you have in the cloning process is equal to your yearly living expenses, you can quit your job and retire. The first year you retire, you subtract 4% from the money that's in the cloning process. And that's the money you cover all your living expenses with. Because there is still 96% of your money left in the cloning process, you can never run out of money. Ever. You can keep performing this trick year in, year out. Plus, every year you can add the inflation number to your initial 4%. Okay, if this all went a bit too quick, let me give you an easy example. So the first year you retire, you take the initial 4% out of the cloning machine at the end of the year. Let's say, for example purposes, that's $40,000 which you take out of the cloning machine. This means in total you have $1 million in the cloning process, because 4% of $1 million is $40,000, right? For instance, let's say the inflation rate is 3%. You then multiply $40,000 by 1.03. That's the 3% inflation, which is $41,200. If the inflation rate is 6% in the third year, you multiply $41,200 by 1.06, which is the 6% inflation, which is $43,672. So if the following year the inflation rate is 4%, let's say, you multiply $43,672 by 1.04. the 4% inflation, which is $45,418. I think you'll get the point. So if you follow this trick, there's no way you run out of money for the rest of your life, since the biggest percentage of your wealth remains in the cloning process. So if $40,000 is the expense of living your life for an entire year, then $1 million is your financial independence number. And you can calculate your financial independence number by multiplying your yearly living expense by 25. So $40,000 multiplied by 25 is $1 million. So now you understand the fundamentals, let's take a look at the different cloning machines you can use. So one of the cloning machines I use is the Vanguard S&P 500 ETF. The average annual return for the S&P 500 from 1957 through 2018 is roughly 8%. And if you use the rule of 72 and expect an 8% annual return, your investment takes 9 years to double, since 72 divided by 8 is 9 years. So that's how the rule of 72 works. You divide 72 by your expected yearly return. The result is the number of years it'll take you to double your investment. The rule of 72 is not 100% accurate, but it does paint a pretty good picture. So as of now, my total investments are now worth $165,000. Whereas 72% of that number sits in the Vanguard S&P 500 ETF. I recently also started to diversify a bit by buying the Vanguard All World ETF. and the Vanguard Emerging Markets ETF. So these investments, or cloning machines as I refer to them in this video, are relatively low risk cloning machines. If you don't want to wait for 9 years for your money to double in value, you need to choose higher risk cloning machines. Higher risk investments can be buying growth stocks of an individual company like Tesla. The stock price of Tesla tripled in value in less than a year. So some people put a big percentage of their total investments into such high risk investments. But the famous investing book, The Intelligent Investor, doesn't recommend doing this. It recommends only putting as high as 10% of your total net worth into a higher risk investment. You should only use the money for such high risk investments you won't lose sleep over if you were to lose it. So the same story for cryptocurrencies, especially altcoins like Dogecoin. So I currently have 15% of my total net worth in Bitcoin and Ethereum. As of now, I'm not buying more crypto because I find 15% of speculative investments in my portfolios already high enough. So coming back to the 4% rule, the 4% rule is based upon historical data, and they use the specific mix of US stocks and bonds. If your investments differ from these specific US stocks and bonds, the 4% rule might not work for you. Therefore, it's important that you only use this 4% rule as a guideline, in my opinion. You need to determine a safe yearly withdrawal rate that feels good for you. On the one hand, you don't want to run out of money while in retirement, and on the other hand, you also don't want to live too frugally and have a mountain of money left when you're already too old to enjoy all of it. So again, the most commonly known withdrawal rate is 4% per year. It originated from a paper published in the US Journal of Financial Planning by William Bengen, a financial planner, in 1994. So according to this paper, when you follow this 4% rule, your portfolio should last at least 30 years. I know, the word should isn't really the word you're looking for when planning your future, right? Well, that's the problem. Since you don't know what happens in the future, it's impossible to know for sure what will happen to your portfolio. According to Williams' research, 96% of retirees at the end of 30 years have a portfolio still worth at least as much as they started with, in nominal terms. So nominal terms mean that when you factor in inflation, the actual value of the investment has diminished. So according to William, if you retired on September 1, 1968 or January 1 a year later in 1969, the retiree won't have any money left over after 30 years. So if you want to retire somewhere in your 30s, you might want to choose a more conservative withdrawal rate than 4%, since you're hopefully still with us 50, 60, or maybe even 70 years down the line. So how do you know what you need when you retire on a year-to-year basis? So in most other YouTube videos, blogs or books, they suggest looking at your last 12 months expenses. But if I were to do that now, it wouldn't be a realistic number. I'm now living in a relatively cheap rental property, I don't have any kids, and I'm aggressively saving and investing. And I also don't know how my business will perform in the upcoming 3 to 5 years. So let's say, for example, my income would double or triple, and in that case, I probably will spend more since I have more money to spend. So looking at my current expenses from the past 12 months, I don't think that will give me a realistic outlook on my future life, since I see it changing a lot in the upcoming 3 to 5 years. Meaning possibly having kids and moving into a more expensive house. If you have most of your life figured out, you can look at your 12-month expenses and work with that. But in my case, I believe if I have 60,000 euros to spend each year, I'm more than happy. And just so you know, 60,000 is way more than I currently spend. Using the most used financial independence number calculator, I divide 60,000 by 4%, which is 1.5 million euros. So as far as my strategy goes, I hope for the best and aim for the worst. So I aim for 3% instead of 4%. This means I need to have 2 million euros invested and being able to call myself financially free. So the moment I have my life more figured out, meaning I buy a house, have kids and have a better understanding of my real expenses year over year, I probably recalculate whether the 60,000 euros per year is sufficient. Once you know your financial freedom number, which is 2 million euros for me, you can calculate how much you need to invest every single month in reaching that number within a specific time period. So for the last 8 months, I am investing 10 to 15,000 euros per month. Before that, I invested 3,000 euros per month, and I started with 200 euros per month in May 2019. So if I were to continue by investing 10,000 euros per month with an annual return of 7%, I will reach the goal of 2 million euros by 10 years without adding dividends. So for me, it's not so much about retiring, stop working and sleep in every day. I like learning and creating stuff, and I don't see myself stop doing that when I reach my financial independence number. I aim for financial independence because I don't want to deal with financial worries in life. Having stress about not paying your monthly bills is something I want to avoid at all costs. If I could pull this off and stop investing after 10 years when reaching the 2 million euro mark, I could let my money do its magic if I choose not to retire. Imagine letting my money sit in the cloning machine for another 10 years. It could double to 4 million euros without me adding new money to it. And you can use the same calculator to calculate how much time it'll cost you to reach your financial independence number. It depends on your monthly contribution, your target number, and the expected yearly return and what time you'll reach your goal. So looking at your current life and your retirement goal, should you change something or are you on the right path? Meaning, maybe you find that you spend way too much on designer clothes, fancy dinners, and should cut your spending if you want early retirement. Or maybe it's the other way around. Maybe you find that you live too frugally and could afford a bit more luxury in your current lifestyle. It's also a good thing to think about your current active income. In other words, how do you make a living nowadays? Are you happy with where you are? Do you enjoy your job? Are you happy with your monthly salary? If yes, then good for you. But if not, you should make an effort to changing your situation. So for me, I worked at an internet marketing agency as an internet marketing consultant from 2015 to 2017. I always wanted to be an entrepreneur and never stopped chasing my dream while working there, my 9-to-5 job. My last day at my 9-to-5 job was in June 2017 and never looked back since. The majority of my monthly income nowadays comes from me selling my 4 self-published books about poppy training, and I sell them on my blog, which receives thousands of visitors every day. And it's not that I built this blog and my books overnight, but I do reap the benefits now since I only spend around 1 to 3 hours per week on it while earning a high salary from it. At least I find it a high salary. So of course in the beginning I work long hours to get this thing from the ground without seeing any monetary rewards. But that's the thing with all long-term goals, right? In the beginning it seems you're not making progress, but looking at the big picture, you're always improving. And I'm not saying you need to start a business or change careers. I'm just saying that I believe almost anything is possible if you set your mind to it. That's all I got to say for this video. Make sure to let me know about your situation. So what's your financial independence number? And what's your current situation? Why are you interested in pursuing FI? Do you want to retire or just like the idea of not having to stress about money like me? Let me know in the comments. Also make sure to subscribe to this YouTube channel because every Thursday there is a new video coming. And if you want to know more about building an online business and such, follow me on my other YouTube channel, where I also publish a new video every Monday. Also check out my website creatoract.com for more info related to building an online business. And if you want to say hi on one of my social, please do so. Almost every day I'm posting something new there. Thank you for watching and hopefully we'll meet again next time. Bye bye.